what we need to disclose and what the importance of this disclosure. The objective here, we need to disclose the significance of the financial instruments. You will find that some financial instrument might have a high significant impact on the statement of financial position and statement of income statement of the company. For example, one of the companies may be mainly relying on issuing bonds. So issuing bonds will take a very big significant part in the company, and it will be recorded by something very effective in our statement of financial position and income statement. So if you have that significant financial instrument and has a high impact on the statement of financial position or income statement, you should in return highlight the risk associated to this significant financial instrument, because definitely there would be a risk, and how the business will manage these risks. So what we should disclose? We should disclose the carrying amount of the financial instrument at the date of issuing. We should disclose any impairment or allowance for credit losses. And this is an example applicable more on financial asset or trade receivables, because again, if you have significant part of trade receivables in your financial statements, you should highlight that there will be a risk associated with trade receivables from provisions of bad debts. You might have some customers went to bankruptcy, you might have some customers have poor credit ratings, therefore there will be provisions that you won't collect all your trade receivables in the near future. So you should highlight what the impairments and what the allowances related to these credit losses. Also, you should highlight the updated values, fair values of each financial instrument, each class of financial instruments. And also, you might highlight the potential gains or losses, income or expenses related to these financial instruments. Because, for example, if you are getting a mortgage loan, for example, at a specific interest rate, and the circumstances in the market changed across time, and the interest rates increased on you, instead of paying 1.5 annual interest rate, you might then pay 3% or 4%, like exactly what's happened in the economic crisis. So the changes that could happen in the market can cause on the company or cause on the individual who is applying for this mortgage loan or is paying this mortgage loan some losses or some extra expenses. Therefore, you should highlight the risk associated to some changes or some fluctuations that could happen in the market, which could be favorable or which could be unfavorable. Definitely, if you are paying interest, if you are paying loans, this something will be not favorable for you. But if you are collecting amount of money, or you have already lending this amount of money, then you are expecting to collect more. Therefore, you should reflect in your disclosure report what are the potential losses or gains or expenses associated to these financial instruments that you are talking about in your financial reports. Also, what are the accounting policies that you are following? What are the standards that you are following? This is very sketchy that you will highlight the standards that you will following to record these financial instruments. So this is just a batch of disclosures related to financial instruments. Should be clear, should be transparent to the users. Okay. As we know that in our annual report, we should disclose qualitative disclosures as we are disclosing quantitative disclosures, because sometimes figures and numbers only will not reflect the whole story behind financial instruments or behind that recording. So we should highlight also some qualitative notes to support these figures and support this data. For example, we should highlight the exposure of risk and how they arise. For example, I have some risk, as we'll see here, I have some risk called liquidity risk or credit risk. So you should highlight the type of risks that you would expose to by going or by recording specific financial instruments. Or you should highlight how the business will manage this risk and what the policies and what the procedures should be taken to manage that type of risk, as I have just explained the example of the COVID cases when they highlighted some risks. So they should at the same time highlight how they will manage this risk and what the actions that should be taken by the company to manage these risks. That's already highlighted in the first bullet. Changes from previous periods. in your disclosure, you need to make some comparisons between previous periods and current periods and to see the difference. If the risks increased or if the risks decreased, you should highlight this to make like kind of comparative analysis to be clear for the users of the annual reports. Another thing, definitely you should disclose quantitative disclosures. You should disclose a summary of quantitative data about exposure to each risk, disclose about credit risk, liquidity risk, and market risk. And this is a very important part here because we have here in this batch of slides, we'll go through 3 types of risks. We have something called credit risk, liquidity risk, and market risk. And you will find each type of risk is associated with a group of financial instruments. So you should highlight here the amount of risk and in quantitative figures, how you calculate this amount of risk and what's its impact on your financial statements. And final thing, you should highlight something called concentrations of risk. So which financial instrument have the highest impact on your financial statements. Definitely not all the financial instruments will have the same impact on your financial statements. Some instruments might have a very high impact and significant impact on your financial statements and definitely will have a higher risk associated to these financial instruments. So you should highlight which one is concentrated or which concentration of risk related to this financial instrument. Then here, this slide is very important because it classifies the risk and explains what is each risk and what the type of each risk is. The first one is called credit risk. So the first risk here related to the financial instruments is called credit risk. So credit risk is related to which type of financial instruments? Here, it's risk of financial loss of the if the counterparty fails to repay. Therefore, there will be a financial loss if your counterparty fails to repay. Therefore, for example, to memorize this is a clear example for trade receivables. Therefore, if I am selling mainly on account or I am giving long credit terms for my clients, there will be a risk from uncollectibles of these trade receivables. The risk from uncollecting my cash from the trade receivables, here it's called credit risk. Credit risk, okay? And this is the type of risk. What I should disclose? I should disclose the maximum exposure. Therefore, I have many clients. I am giving credit terms for many clients. What is the maximum exposure to this risk? I will expose to this risk on a high level. I expose to this risk on a mild level. Depends on the client itself. They are usually paying me. They usually miss the due dates of payments. Some clients, they don't pay at all. Therefore, depends on the circumstances of the company and the relationship between the company and the counterparty. They will determine the exposure of this risk will be by how much. And also, they should highlight the collateral. For example, here the banks, when the banks are providing mortgage loans, so people will buy homes based on this mortgage loan, so the collateral is the property itself or the asset itself. So based on this, if you have a risk that you might not collect your payments, what is the collateral if you fail to repay this amount of payment? And the quality of financial assets, analytical of disclosure of past due, impairment of financial assets. If you have many clients, you should split down and make like an analysis. I have how much people are not paying me and what the percentage of the clients or counterparties that you are frequently paying, how many are missing their payments, how many are not, I'm not receiving from them at all, like make analysis so things will be very clear to the users when they read about this risk in your annual reports. So this concerning credit risk, so all the time to remember credit risk is associated for what? Credit risk associated for failing to receiving some amount of cash from some transactions or some contracts with your counterparty. Second one, liquidity risk. And liquidity risk from our point of view, it means that I might not have enough liquidity to pay my obligations, right? I might not have the enough liquidity to pay my obligation. So this is the other side of the credit risk. Credit risk, you are expecting to collect, therefore there is risk from not collecting. However, liquidity risk is a risk from not paying on the other side. So the most famous financial instrument here is trade payables. Therefore, it's risk of difficulty in meeting obligations related to financial liabilities. Therefore, you issued bonds, you borrowed loan, you have some trade payables should be paid, and there is a risk of not paying this. There are many reasons that you might not pay these amounts of money. Maybe you went for bankruptcy, maybe because in 2020 because of COVID circumstances, maybe because of recession. There are many reasons that can hinder you from paying these payments of liabilities. Therefore, here we have some kind of liquidity risk.